Welcome back to our ongoing case study of Constellation Software. We are returning to the books for an audit of the fourth quarter of 2025. This software conglomerate usually operates quietly, but it currently faces two very public pressures: the mathematical friction of its massive scale and the looming threat of artificial intelligence disrupting its core business. Before we begin, please note this breakdown is strictly for educational purposes. This is not investment advice, and historical returns do not guarantee future results. Q4 2025 results present a sharp contradiction. Revenue and EBITDA growth remain strong, yet free cash flow available to shareholders, the firm's primary metric for success, suffered a 12.4% year-over-year drop. This decline occurs as market skepticism grows regarding the resilience of traditional vertical market software moats in an era of automated code generation. Resolving the disconnect between these reported results and the company's operational reality involves a granular look at the underlying software metrics, the new strategy for public market stakes, and the accounting mechanics currently masking their cash generation. Assessing the health of the business begins with the top-line operational data, separated from the immediate volatility of the cash flow report. Net revenue grew 17.6%, while EBITDA jumped 25%. These figures establish a baseline of robust growth. The maintenance organic growth metric accelerated to 6% year-over-year in constant currency. This chart tracks maintenance growth. Historically, Constellation operates within a 3 to 7% range. Hitting 6% puts them at the upper boundary. Management confirmed this occurred without customer churn or pricing pushback. Their specialized software remains highly sticky. Regarding capital allocation, the firm has already committed over $800 million to new acquisitions in the early months of 2026. They achieved this volume while maintaining their internal return hurdles. Despite broader market noise, the foundational vertical market software moat remains intact. Pricing power is holding, and organic retention is solid. Beyond the financials, the company is addressing the market consensus that artificial intelligence will commoditize software creation and erode their competitive advantage. Management takes the stance that building software features faster will soon become industry table stakes. In their view, speed of coding is not a long-term differentiator. Their defensible differentiator remains the deep vertical knowledge, embedded customer workflows, and proprietary datasets accumulated over decades in niche markets. The company has already upskilled thousands of developers across its subsidiaries in AI-augmented coding to improve internal efficiency. These productivity gains are being reinvested into research and development. The goal is to accelerate product roadmaps and add value for customers already locked into their ecosystems. Rather than centralizing this development, they rely on a decentralized culture to share best practices via regional accelerator events, keeping the decision-making close to the specific customer needs. Constellation is weaponizing AI as an internal efficiency lever to deepen customer lock-in, neutralizing its threat as a disruptive force. The conglomerate faces a structural challenge known as the law of large numbers. As the revenue base grows, it becomes mathematically difficult to deploy billions of dollars in free cash flow. Relying exclusively on small private acquisitions is restrictive when managing a multi-billion-dollar pool of capital. To solve this bottleneck, the firm introduced a strategic evolution, the Permanent Engaged Minority Shareholder Strategy, or PEMS. While the traditional model involves 100% buyouts of private companies, PEMS involves taking minority equity stakes in large, publicly traded corporations. This strategy often includes securing board representation. It allows Constellation to influence the target company's governance and capital allocation over the long term. Management applies the same historical return hurdles to these public stakes as they do to private acquisitions. This represents a calculated evolution of their buy and hold forever ethos, now applied to public markets at scale. We can now address the reported 12.4% drop in free cash flow available to shareholders. With EBITDA margins expanding and organic growth at cycle highs, the source of this cash flow decline is found in the company's financial structure. The primary cause is a complex mechanic called the IRGA liability. IRGA refers to the Investors' Rights and Governance Agreement. When the firm spun out its European subsidiary, it granted minority founders a perpetual put option, allowing them to sell their shares back to the company at a formulaic price. Under IFRS accounting rules, this put option must be recorded as a financial liability and marked to market every quarter. Free cash flow available to shareholders is calculated by taking operating cash flow and subtracting capital expenditures, leases, and the quarterly IRGA liability charge. The IRGA liability increases based on the success of the subsidiary's publicly traded equity investments. Because those underlying stocks surged in value during Q4, the liability spiked. This triggered a massive non-cash charge against the reported cash flow metrics. The cash flow drop is an accounting quirk, a literal tax on success that penalizes reported metrics precisely because the underlying investments are performing well. This clarifies the structural drop in return on invested capital. This ROIC compression is a mathematical consequence of deploying larger tranches of capital, rather than a decline in management's pricing discipline. The cash accumulating on the balance sheet reflects a refusal to overpay in a competitive market, maintaining their standards over immediate deployment. Beneath these capital constraints, the operational engine remains untouched. The company absorbs the AI shockwave, converting a potential threat into a proprietary advantage. They are addressing the law of large numbers through innovations like the PEMS strategy, finding new ways to put billions to work. The compounding machine continues to evolve, masking its operational strength through accounting complexity while executing in plain sight.